Hi everyone and happy Friday. It's Friday, 8th of May. We could have woken up to news that the Iran war is over, but no. Tensions revived again yesterday, sending crude prices rebounding a little bit, not too much, but uncertainty creeps back in. And as we keep turning round and round on Middle East headlines, today's US jobs report will give a hint as to whether investors are starting to reflect central bankers' rising concerns about inflation, with price pressures increasingly taking over the jobs data in shaping the market expectations or not. So we will discuss about all that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
What a week it has been, and it's not even over just yet. A real roller coaster. Started with renewed Middle East tensions, remember, on Monday, sending oil prices up to $115 per barrel level. Then tensions eased and markets breathed a sigh of relief thanks to the US unwillingness to escalate tensions, and euphoria kicked in on news that even a peace proposal came to the table. Meanwhile, the week's most closely monitored earnings went extremely well, to say the least. Chip stocks rallied on better than expected results from Samsung and AMD primarily. Nasdaq renewed record after record, and the good mood got a sugar coating from the falling sovereign yields as falling oil prices also pulled the inflation expectations lower around the globe and softened the central bank's policy forecasts. But all of a sudden, surprise, the potential Iran deal headlines got replaced by the news that the US struck military targets in Iran after the country fired on 3 Navy destroyers sailing in the Strait of Hormuz, naturally suggesting that we are back to square one. So US crude rebounded past the $98 per barrel level and is consolidating just below the $97 per barrel mark at the time I'm talking here, while Brent crude settles above the $100 per barrel level at the time I'm talking here. The price action is not reflecting the ongoing risk of oil shortage to the full extent, in my opinion. Maybe news that some ships made it through the Strait of Hormuz this week by going black, so by turning off their navigations, but some charts that start creeping in are much less encouraging than that. I have in mind the European jet fuel reserves looking like a nose-diving play into the summer vacation. So here we are again, Friday morning, and we have no idea how the situation will evolve. But the track record of the past 2 months is not really promising, and Friday close is always quite a critical moment as the US tends to make decisive moves during the no market hours to give investors time to digest the information, the news, and hoping to kick volatility down to Monday to eventually drown out bad news with encouraging, often unfounded announcements and hoping that the markets would rally. And it's got the merit to work quite well because since the start of the war in Iran, the S&P 500 has hit fresh record highs 9 times if my count is right. And you know what? The US futures are again in the positive this morning at the time I'm talking here. On the earnings front, well, Whirlpool's warnings that record low sentiment due to the Iranian war and the doubling of the gasoline prices in the US plunged demand for appliances to a level that the company says could lead to recession level industry decline. Doesn't show the same enthusiasm than the earlier technology earnings. The stock plunged 12% yesterday, but the technology heavy S&P 500 was just too busy flirting with fresh all-time high levels. Oh well. Anyway, we have one more thing to watch before this week's closing bell, and that's the US jobs report. The US economy has been in a stage of low hiring, low firing, with latest jobs data suggesting that the slowdown is not as badly as it was feared. Earlier this week, remember, the ADP report printed lower than expected job additions of around 109,000, but the number didn't sound alarming either. And well, the data certainly got diluted in the middle of more exciting war and technology earnings headlines. And the headlines will remain busy with geopolitical tensions today, but today's official jobs data from the US still deserves some attention. The median forecast on the latest Bloomberg survey points at 65,000 new non-farm job additions in the US that investors expect during last month, with a rebound in average wages growth from 3.5% to 3.8% year on year. Now, those who watch these episodes regularly know that I repeated several times earlier this week that estimates regarding the jobs performance diverge remarkably right now. Some expect the US jobs market to have added a significantly lower number of jobs last month or during these months compared to the median forecast, pointing at the thousands of job cuts that we hear from the big technology names and other names as well due to the AI replacement and also the ongoing immigration struggle in the US. While others predict that the massive AI spending, we are talking about hundreds of billions of US dollars, will create jobs and should limit at least the AI related slowdown. So it will be interesting to see where the data lands today. As per the market reaction, I would expect a set of stronger than expected figures keep the Federal Reserve hawks in charge of the market without necessarily taming the equity appetite, because the latter will likely depend on the war headlines or just nothing, to just go high. Then a set of softer than expected jobs figures could revive the dovish Fed expectations and give a further support to equity valuations if, of course, the war headlines leave some reaction space to investors and the wages growth remains reasonable. By reasonable, I mean a figure in line and ideally softer than the 3.8% expectation on a yearly basis, while uncertainty about oil prices remains very, very high, obviously. And this last part is important because some Fed members are growing more concerned about the inflation outlook than the health of the jobs market. This is a notable shift compared to the pre-Iran war narrative, mind you. And that change from worrying about the softening labor market to worrying about overheating price pressures puts inflation data front and center, and that includes the wages data, while making jobs data the headline NFP number somewhat secondary when it comes to guessing the Fed's next move. So let's keep our fingers crossed. The best outcome for the market would be relatively strong job additions with a relatively softer wages growth. Speaking of good data, let's end this episode with a smile. Bank of England officials are apparently worried that the UK's economic data looks just too good to be true, and more importantly, that it may be sending a misleading signal to markets, making the job of setting monetary policy even trickier than what it already is with the Middle East jitters. In fact, the first quarter growth numbers have consistently come in strong since 2022, only to fade later in the year. It probably has to do with the consumer behavior and the post-COVID spending habits, it is said, and that the ONS didn't find a way to iron out the numbers for seasonally adjusted numbers to be consistent. If that pattern repeats again, the Bank of England could end up tightening monetary policy more than necessary in its fight against inflation and into a more rapidly deteriorating economic outlook for the UK than the early year data suggests. Now, well, that doesn't sound great for the British pound that has been bumping its head against the 136, 137 offers against the US dollar, and that has been persistently weakening against the euro, as being left to the US mercy doesn't pay well these days. But there's still the hope that the Middle East war comes to an end and everything gets better. So let's hope for the best and be prepared for the worst. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.